Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. Much of the conversation in markets today centered on Fed independence. Today, Fed Governor Lisa Cook indicated that she will promptly challenge President Trump's move to remove her from the Fed's board. Now, Cook's personal attorney said she's going to file a lawsuit, and the Fed said it will abide by any court decision. We had a weaker dollar today, yields on longer-dated U.S. Treasuries up in New York trading, and we'll bring you some perspective from the Asia-Pacific momentarily when we hear from Kerry Craig, Global Market Strategist at JPMorgan Asset Management. But we begin here in the States. Joining me now is Robert Schein. He is the Chief Investment Officer at Blanke Schein Wealth Management. Robert is on the line from hot Palm Desert, California. Thank you, sir, for making time to chat with me. Can I get you to weigh in on what has been happening between President Trump and Fed Governor Lisa Cook?
Well, if you start the year, moving into the new year of the Trump presidency, he was very vocal out of the gate that he wanted to reshape the Federal Reserve. And I think over the last few weeks, he's found an opening and an opportunity to sort of see through what he sees and he believes is the proper way of shaping or reshaping the board, the presidents, and the Federal Reserve. The challenge that we have there is that this should be completely independent from Washington, and oftentimes history has shown it's not been from previous presidents. But this is the most aggressive we've ever seen. So what played out today, I think, is historic.
If Trump were to succeed, he could secure a dovish majority on the board. And at a time when he's pushing for lower interest rates, we know. A key question now seems to be, Robert, whether aggressive Fed easing could ultimately send inflation higher. I think that risk was underscored today if you look at the steepening of the Treasury curve. Is that a risk that we need to take seriously?
1,000%. You've had me on several times, and even before this all played out, I was in the camp of even last year at this time, the Fed's going to be higher for longer. They're going to have to be. Historically speaking, if you look at the last 5 bouts of inflation going back over the last 100 years, 2 of those have really impacted inflation negatively by having easing policy, lower interest rates for too long, too quickly, forcing, if the most recent is the late 70s, early 80s, forcing inflation to spiral upwards out of control. And the Fed had to react very hawkishly as a result. We understand that we still technically are a restrictive policy, but the GDP is still growing. And so companies are still earning. This last earnings call, if you look at the 90% of the S&P 500 that already have reported, we're looking at double-digit earnings growth. So there's a challenge there. Obviously, we have to look at the labor market, and that's the Fed's job to make that balance. But right now, we could be treading some difficult territory here.
Yeah, the earnings story is definitely a part of this bullish script that the equity market has been trading off of. And it also includes the likelihood of a September rate cut, along with, as you pointed out, resilient economic growth. So we have the numbers after the bell tomorrow from Nvidia. Give me a sense of what you're expecting.
Since Nvidia's first quarter earnings, Nvidia's up 35%. So they're going to have to continue to throw up some amazing numbers in price for perfection to continue their path. Now, is the AI story real? Absolutely. Are we going to see some sort of follow through trading on this? Yeah. Is it a buying opportunity if Nvidia sort of stubs their toe because of the H20 and they can't sell to China and those are not in their numbers right now? I think that's going to be the story, saying, okay, not what the results are, but what the guide is moving forward.
It seems like the market has really struggled lately to try to broaden out a bit. Why do you think that's been such a challenging dynamic?
We've seen it actually take place earlier this year, beginning of April, but since April 9th, technology as a sector has regained the throne, if you will. We do need to see other sectors. We have seen financials sort of catch a bid, which is good over the last few weeks. But healthcare is one of the biggest laggers. But so if we want to see a healthy market moving into 2026, we need to see that broadening out continue. And we're seeing signs of that. Also down the capitalization specter, mid caps and small caps in the Russell 2000, obviously in the anticipation of lower interest rates starting in September. We're starting to see that movement, which is all positive because technology, while it's brought us here to the party, it'll keep going. There's other areas in the market that need to participate to maintain the bull market.
You mentioned the labor market a moment ago. Today we had from the Conference Board the reading on U.S. consumer confidence moving a little bit lower in the month of August. And there is some concern on the part of those surveyed about the prospects for finding a job. Give me your sense of where we are right now in terms of labor market activity. Are we beginning to put in a bottom, or do you think that there is a lot more weakness on the horizon?
I don't think anybody knows about the labor market because we're trying to get a handle on the data. I think the biggest change in tenor from the Federal Reserve was when Jerome Powell actually referenced the data that is maybe not 100%. And he's been data dependent. The Federal Reserve's been data dependent on the labor market to date. So, and obviously we've seen what the administration has done looking at the labor market and sort of the surveys. I think we are going to see weaker reports, I think, maybe underreporting both sides. Probably what I'd be curious to see is what percentage of the government labor new jobs is being added versus the rest of the marketplace. I think that's where the true health is to see our entrepreneurs adding, our business owners adding. Is the private market actually participating? If so, to what magnitude and what percentage? Because that's where the confidence comes in. Obviously, we have the big, beautiful bill that could add in some CapEx incentives for small business owners moving forward. I think that's sort of your catalyst to look forward to. But yeah, the labor market's in question, and I can see it slowing.
So we had this unorthodox deal recently where the U.S. government has taken a near 10% stake in Intel. And today, Commerce Secretary Lutnick was suggesting maybe the government could take a position in a defense contractor or a company in another industry. How do you feel about some of the industrial policy that is coming out of the Trump administration?
Well, it's not new. We saw the government be a backstop in the great financial crisis in our auto industry. So, and if you look at some of those trades, long-term holding, the government made a lot of money in a lot of different areas. Simply because they have the ability to hold it long term. Now, there's the other side of the coin, which is, they're not private companies anymore. Or excuse me, you're sort of, privatizing these institutions that are publicly traded companies, but you're also having the government sort of weigh in. And now, is there the opportunity long term to make money? I think that's ultimately what the administration's moving towards. And backing some of those companies that are U.S.-based, broad-based in terms of manufacturing and production, and supporting those based upon the overall sort of theme that they're coming forward with. The bottom line is I see them making more moves like this, and I think long-term, I think they'll play out positively for the U.S. taxpayers.
Robert, we'll leave it there. It's always a pleasure. Thanks so much. Robert Schein there. He is the Chief Investment Officer at Blanke Schein Wealth Management, joining from Palm Desert, California, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We stay with today's theme of Fed independence. Yields on 2- and 5-year Treasuries moved lower in the U.S. session, and they are posting further declines right now in Tokyo trading. However, it's a different story at the long end of the curve as investors seem less keen on duration. For more, we heard from Kerry Craig. He is Global Market Strategist at JPMorgan Asset Management. Kerry spoke with Bloomberg TV host Paul Allen and Avril Hong on the Asia trade.
Kerry, thanks so much for joining us. It's kind of an interesting picture at the moment. We're seeing equities continuing to rally. Even the Russell in the US was moving higher. The short end of the curve seems, yields are dropping there. In terms of Fed independence, is the media more worried about this than markets at the moment?
Good morning, Paul. I think it is something that represents a tail risk to the market at the moment, but more broadly, the equity market has been supported by the earnings outlook, the fact that you are seeing still a robust economy in many parts of the world, or at least that not recession being priced in anymore. And at the same time, it's hard to think about an equity market that's going to collapse without seeing a significant trigger for it. So I think what we're seeing at the Fed at the moment is very much a tail risk. They haven't seen a huge reaction in the markets because it's new. How do you really price this in terms of what may happen when we know there's going to be potentially a lengthy legal battle around it? And so it's very hard to gauge what the exact outcome may be. So I think you're seeing some small moves there in the dollar in the US and also in the long end of the curve. But for here and now, I think the implications are really around still softening economic policy in terms of the monetary policy from the Federal Reserve. And that's being sort of viewed as a tailwind for markets.
Yeah, and more presently, as you say, in the shorter term, there are some other fish to fry. We've got the PCE numbers later on this week, and then in the middle of next month, the Fed going to hand down its decision. What's your expectation around those inflation figures, and what's the bigger concern for the Fed right now, inflation or the jobs picture?
Well, I think that the Fed has that dual mandate. They're thinking about their inflation target, their full employment. I mean, their view on full employment is 4.2%. They're at that. They have their full employment ticked off, as it were, and you've got inflation that is, in terms of headline CPI, probably closer to 3%. The PCE number is going to be moving higher, probably in our view, over the course of the release this week. And so you would argue that their inflation target is further, or inflation is further from their target than unemployment rate. However, what we heard from Jackson Hole and Fed Powell is that they are concerned around the softness in the labour market, and so they're going to sort of support growth in this environment. I don't think a rate cut's going to do much for the economic outlook initially. I think it is going to lead to some concerns around a little bit more inflation, as will these views around Fed independence. And so I think you're likely to see the market start to reflect the potential for a little bit more inflation in the future, even if we do get those rates cuts coming through over the course of September and into the end of the year.
So how much further curve steepening are you expecting, and how is the best way to position?
Yeah, I think the curve's about 60 basis points between the 10 and the 2 at the moment. That's quite significantly steep than it has been for some time. Again, we would be arguing that there's probably more scope for easing from the Federal Reserve. So 2 cuts this year, potentially more into next year. That should weigh on the short end of the curve. And at the long end, you are going to have some more inflation expectations being built in, or at least inflation volatility that sees those yields probably not move down as much as you may think they were. So curve steepening seems to be a pretty popular way to play the market at the moment. We would do think that having a bit of duration in a portfolio is not a bad thing, given those growth risks that are out there. I mean, there's not a zero chance of a recession happening, and it's probably a little bit above average. However, we don't want to walk too far out the curve, given some of those movements in the longer end of the bond market that we have seen. So I think it's quite finely balanced when we think about where you want to sit within the curve in terms of duration, but definitely viewing it as a steepening yield curve over time.
Kerry, we're also looking ahead to Nvidia earnings. Amid this, we're seeing Asia stocks. They seem to be running a bit higher at the moment. We have the tariff backdrop as well. India could be facing double the rate. South Korea came away with the meeting in the US from a positive tone, deals bonanza. I think we're hearing about some of these Korean companies and their expansion plans in the US as well. How are you playing South Korea, particularly related to Taiwan? Do you see outperformance there potentially?
Yeah, I think we're still quite favourable on North Asian markets more broadly, whether it's China, Taiwan and Korea. I mean, they have done very well this year in terms of their performance, so I think that's something to bear in mind. And valuations have moved up a little bit. I think the tech cycle still has more to go, and the carve-outs we've seen around some of the semiconductors being put into those deals, the offshore investment that will go into the US from some of these companies being something that will support that market. And I think secularly that AI theme is still very prominent, so we would argue that those are going to be the beneficiaries of it. Whether it's China or Korea, I think you're really coming down to a couple of companies that are driving that decision. So it's really more of a bottom-up view in terms of which of those companies you think are better positioned in this environment, rather than thinking about those countries. So I think it's a couple of stocks that really driving the decision between South Korea and Taiwan in terms of relative performance, not necessarily just thinking about the country there.
Yeah, in terms of tech in China, we've seen a pretty strong run up there, and in fact a pretty strong rally in general when it comes to Chinese equities. How's that looking to you? Do you feel there's a risk of a correction here? Does the fundamentals stack up?
Yeah, the fundamentals do look quite good to us. Obviously, there was the valuation argument from earlier in the year, and Chinese equities still look relatively well priced compared to many developed market peers. There's some appealing characteristics to the onshore market in China, given the lower correlation they have to the US equities, so building in a bit of a diversification of portfolio. But fundamentally, again, thinking about that tech theme, Chinese tech is a way to play it that's not related to the US and some of the risks that come with that. And we do see that as being more prevalent. It is a little bit disconnected from what we're seeing in the economy as well, given the softness in some of the economic data and only the slow movement in fiscal support coming through from the Chinese government. So I think there's still room to go into China. I think it becomes quite an active position given the outlook for the economy. And again, we're seeing that bit of a split between what we're seeing in the offshore and the onshore market, where it's really the offshore market where you're seeing a lot of these tech themes being more prominent, whereas the onshore market seems to be a little bit more about dividend and income, some of the performance in the financials. So I think there's very much different ways to play China depending on what you're looking for in terms of growth versus income at the moment. But it is a market that we do continue to like in terms of where we can find value around the world and looking for continued performance.
Where are you seeing risk at the moment, and how are you hedging against that?
I mean, I think there's a way of framing how investors are feeling, and that's a little bit of sort of uncomfortably tolerant of what's out there at the moment. Obviously, markets have run pretty hard since we've seen that sell-off in April. There are concerns around some of the softer economic data that's coming out, obviously the political risk that's still in there. But, you know, fundamentally, we do see a global economy that's improving, and that should support the outlook for both equities in terms of risk and nominal growth, but also it's not huge growth. It is subtrend growth around the world, and so we do think about duration in terms of a hedge against that growth shock in a portfolio, but also barbelling that with a little bit more of the credit space in terms of high yield, given the carry that you're getting on that, and rather than owning outright duration. The other hedges against that inflation, I think that for us really does default to things like alternatives and real assets, where you're getting that less sensitivity to the economy, the good outcome, and obviously some inbuilt inflation protection as well. So we need to think about a broader diversification of assets within a portfolio to really counteract all the risks that are out there in the global economy.
All right, Kerry Craig, Global Market Strategist at JPMorgan Asset Management. Thanks, as always, for joining us with your views.
Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.